So I'm often asked by new investors, what should they look for when investing in multifamily properties? And I know that it can be a little complicated because it takes into account a number of different variables, such as aligning the specific strategy, the objectives, and the real estate cycles, and the realities of the current market demands. But the common thread that's going to bind all of these types of acquisitions is what I like to call the big three. Now, these three location metrics inform every single investor to make, in my view, the foundation of a successful real estate investment. So what are they and why do they matter? Number one is going to be the demand generators. Now, these factors determine the local need for your investment property. It's essentially the presence of businesses, employers, transit, schools, and attractions in the area that will generate the consumers that your property is intended to serve. And number two is going to be supply indicators. Now, as part of every due diligence that you're going to need to do in a new market, identifying the direct competition is going to be based on these three P's: price, product, and proximity. When considering a specific property type for investment, you want to gauge the existing demand for that property type and then take into account the future developments that could oversaturate the supply. Now, these attributes impact a market's current and future vacancy rates, which are key components in forecasting investment performances. So for commercial real estate investments, I consider healthy vacancy rates, typically within the range less than 5% for multifamily. Most cities have a chamber of commerce which will publish useful data points and various real estate databases that will have transaction details that will inform supply and demand metrics. Keep an eye out for articles from local news outlets highlighting economic trends and future developments. You don't want to overlook these resources when performing a market study. Number three is going to be market comparables. The final metric that's going to make up the big three is comps, or the comparable lease rates and the sale prices from the past 3 to 6 months. Comps are important because they indicate how much revenue that you'll be able to generate from these investments and whether a certain location is crowded with too much supply. So when evaluating real estate comps, it's essential to recognize the different regions. Even a section of a city or a street by street level can be very different, in terms of lease rates and sales prices. These metrics should be carefully researched to filter for property types and to benchmark the specific locations. So while comparing, price per square feet can be helpful, the best comparisons for benchmarking and determining investment revenue will also take into account the age of the property, the use of the unit mix, and the structural and cosmetic upgrades. So I hope this information was helpful for you. If it was, please be sure to follow me for more multifamily real estate tips. Thanks.